Trump's economic policies are extremely pro-growth, but the big concern is on how he implements tariffs.
The economy is not sending any signals that we need to be in a hurry to lower rates.
Can these tariffs make America great again, or will they reignite inflation? Tariffs are essentially a tax on imported goods. Picture this. The US slaps a 25% tax on imported steel from China. Suddenly, it cost American companies who import steel from China 25% more. As a result, these companies are incentivized to turn away from buying Chinese steel, which hurts the Chinese economy and opens up opportunities for domestic production, which means US producers of steel would need to expand their production. And as production scales up, it creates a surge in economic activity. More construction, more jobs, higher wages, bigger economy. Essentially, the GDP that would go to China is now redirected back into the United States economy, making the US a stronger manufacturing base. Now, ultimately, this would boost US jobs growth and make the US less reliant on other countries, improving national security. But the goal is to not actually have to implement tariffs. It is to bring other countries to the table, to negotiate, to get them to remove barriers that restrict US goods from competing in their markets, which would simultaneously ramp up US production. Trump wants US goods to compete in these foreign markets. Currently, the US spends more than it makes. Imports are bigger than exports, which leaves us with a deficit. And by producing and exporting more, Trump wants to close the deficit. In 2023, the US trade deficit was over $700 billion, which could be $700 billion of inflows from those other countries. And if these countries feel threatened enough to open their markets to US goods, the US trade deficit improves. So the Trump administration argues that imposing tariffs on countries that the US has a significant trade deficit, will force these nations to open their markets to American exports, pumping the American economy. In other words, increasing revenues to pay for these massive tax cuts. But of course, nothing ever works out perfectly. There are trade-offs to leveraging tariffs. If other countries start to retaliate, issuing their own tariffs against the US, nobody wins. This would be another trade war, and nobody wants to see that. Now, some people believe Trump will keep an eye on the stock market as he implements these trade policies. Assuming he's learned from the last trade war, the market doesn't like escalation.
And remember, there's only two scores Trump cares about, his golf score and the stock market. He's fixated on the stock market. Everyone around him will tell you that. He will tell you that with his tweets.
The other trade-off is that US companies rely on imports for their materials. Not only are they cheaper, but it takes time to transition to American production. US companies that rely on foreign parts and materials may have to scramble for alternatives, creating inefficiencies and supply chain disruptions. American workers demand higher wages, and a mass deportation of the labor force would also put a drag on production, pushing price pressures higher. This is inflationary growth. If you want to protect US jobs and boost US production, you're going to deal with higher prices for consumers and input costs for businesses. But the Trump administration has a counter argument. They pledged to cut energy prices in half within a year. By ramping up energy production, this lowers the cost of running the economy, as energy is the base function to the entire economy. And if energy prices are much lower and tariffs are announced well in advance, businesses have time to adjust, time to prepare, time to increase their supply, which in turn helps to stabilize these inflationary pressures. Now, companies are already adjusting their supply chains closer to the US manufacturing base and prepare for any potential disruptions from the tariff policy. But let's remember, tariffs are primarily a negotiating tool. If India, the European Union, and China come to the table before these tariffs are implemented, well, that would be an ideal situation. But if foreign countries start slapping tariffs on American goods, US companies will suffer. And the escalation would not only drive up inflation, but lower the overall growth potential of the US economy. This is why tariffs are so risky. They must be strategically and selectively implemented. The truth is, no one knows exactly how this situation plays out. And this is where we turn to the interest rate market. If inflation becomes a real threat, bond yields will continue to rise. But if growth is more likely to collapse, bond yields will also collapse. If earnings growth is threatened, The stock market will correct well in advance. And if geopolitical risks rise unexpectedly, the VIX will rise consistently above 20.